Hello, everyone. This is Anthony from Traders Ultimate Edge, and let's talk about options wheels today. Talk about options wheels, and I use these in my personal income account, along with a few other little strategies. Generally selling credit against the SPX, that sort of thing. But it'll usually average out to about 30% annualized, which is fantastic for an income account, and I want to share this strategy with you. Advance our slide here. Okay, we'll talk about the three pillars, if you will, of wheels. This is kind of an overview of it. Generally, what you're doing is selling a covered put, you're taking assignment, and then you are selling a covered call against the stock that you took assignment. All right, that's the basic overview of the strategy, and we'll break that down into a few pieces here. All right, so firstly, what is a covered put? A cash covered put, or also called a cash secured put, is a put that's backed up with enough cash in your account to take assignment of the stock. So for example, if you sell a put at a strike of $50, you would have to have $5,000 in your account in cash in order to cover it. That's because most options, not all, the ones that aren't are especially notated, but nearly all options revolve around in strikes of, in lots of 100 shares of the stock. So that's why it would be the strike price times 100. It's the amount of cash you have to have in the account in order to cover it. Now, this wheel strategy, this is important to note, we only deal with selling covered puts and not naked ones. Okay, that's an advanced strategy. So essentially what happens here is you sell the put, and if you're assigned, you take possession of the stock. All right, so there's a couple of different ways to sell these puts, a couple different places that you can put on, that you can select your strike. You can pause this screen and take a look at it. When I do this with my clients and I do it live, I'll go through the charts and I'll show them, okay, this is where I want to sell if I want the stock. This is where I want to sell it if it's just for income, that sort of thing. So you can sell these things, if you want them to go worthless, you'll sell them way below where the current price is and below support. All right. If you want to try to take assignment of the stock, but only at the right price, then you would select something a little bit higher. Or if you're guaranteed to take assignment, if you really want the stock, you could even sell right at the money. Or even slightly above the money if the credit is favorable to you. Sometimes you can sell slightly above the money, and the credit is actually favorable doing that. So again, you can kind of look through these here on your own if you wanted to pause this. I'm really just trying to give you a broad overview of the strategy here. But basically what we're trying to do is find a low risk, low reward option for an income account with a worthless one here. So you try to sell it way below the money, and what you're trying to do here is just let that put expire worthless. Okay, this one over here. This is generally what I'm going to do is I want the stock, but I only want it at the right price. So I'm going to sell a put down there right at support. So if it does get assigned, it's got nice support in the stock, and it can push right up. So it's that's generally what I want to see, and this is usually how I'm entering for a wheel. Okay, and this is like I was mentioning in the last one. If we want the stock, if for example we're really hot on it, then we can sell like right at the money, more or less. Okay, when would you close a put early? Well, this is largely a matter of personal preference. It can be done when the stock has moved up in price a significant amount, so much so that the put you originally sold is now available to repurchase at less than or equal to $5. So for example, if you sold that 50 put that we were talking about earlier and the price of the stock just flew up, now it's worth $60. Well, that put's probably pretty much worthless. So you might be able to buy it for $2. So you can just rebuy it. And then the pro of that is that you're able to resell quicker for the next week. So you can just go ahead and immediately reopen another position for the next week if you'd like, and you can pull in some extra credit, or you can even sell again for the same week. I've done that before. Now, the con here is that you're going to spend a little bit of money to close that position. You spend your $2 or $5 or whatever plus your commissions. So you are going to lose a little bit, and those do stack up against you. So be sure that you want to close that. Be sure you want to close it early because those will stack up against you in the long run. All right, next up. Here's the conclusions about how you'd want to sell a put, right? Determine how you'd like to enter the stock. Choose, the type that you're going to sell based on how I presented it. If you just want the income but wouldn't mind the assignment, because keep in mind, there's always chance of assignment. Are you just looking for income but wouldn't mind assignment of this particular ticker? Then, it's type 1. Try to sell it worthless, right? Way out of the money. Sell it closer to the money or sell it in the money, depending on how badly you want the stock. And this is something to keep in mind. If it's a stock you really want and it's on a trajectory that'll be difficult to catch, well, maybe sometimes we just open straight from purchasing the stock, and we'll talk about that in a moment. Okay, now let's talk about taking assignment. You sold the put, and the stock is assigned to you, which means the price of the stock, the price of the underlying stock, has dropped below the put strike price at time of closing, or at time of expiration. Expiration is typically, not always, but typically, close of the market on Fridays. Close of the market on Fridays. And if the price of the underlying is below your strike price, then you'll be assigned. You'll just wake up on Monday and your cash will be gone and 100 shares will be in your account. Typically. Sometimes you have to pay brokerage fees. That's going to depend on your broker. If you're running wheels, then make sure that you're not running it with a broker that charges you for that, because assignment, both on the put and the call side, is part of running wheels. Okay, and you don't want to get charged fees for that. All right. So congratulations, you got assigned. You now own the stock at a nice discount from where it was on the day you sold the put. And here's the thing. If you were, now here, let's see, it says it here next. For it to be assigned, it would have closed below your strike price. It's not a problem. This is what we wanted, okay? If the price of the stock has fallen below where you purchased it at, it's going to show red on the first day. But that's okay. If you want to feel better about being in this stock at this point, look back at the price it was on the day you sold the put and, calculate how much you'd be in the red if you had bought it on that day. And that's the point. We're getting the stock at a cheaper price. And this is actually a strategy that you can use to add into your long-term accounts. If there is a stock that you want 100 shares of, you can sell puts against it until you get assigned. And that way you get it a little bit cheaper. All right. So now you can also open a wheel from this step, and this is what I was talking about. If you're bullish enough on a stock, trying to enter with a put may be really difficult because it may just take off, right? In which case you'll never get assigned. In certain situations, it's possible to enter the wheel immediately by buying 100 shares of the stock and selling a call against it. If you do that all in one step, it's called a buy right. It's not really important, but it's called a buy right, and it might actually say buy right on some platforms. Personally, I prefer to do it separately. I'll just buy the stock, and then I'll go sell my call against it. Okay, now here's what everybody always wants to know. What happens if the stock tanks immediately after I sold the put? Option 1, you take assignment. If you're longer term bullish on the stock, and you should be, longer term bullish on a stock for any stock used for the wheel, then take assignment and wait it out. Okay? Option 2. This is my preferred choice. You're going to roll the put out to lower strikes. All right? So if you're on expiration day, it's looking like you're going to have to take assignment to this thing, and it's pulling below your strike price, you don't like it, then roll the put out. Or, what if it happens immediately after you sell the put? We'll roll the put out. All right, roll it out. And if you roll it out a couple of weeks, you can usually get lower strikes on it. So if it does assign, it's at a lower price. And you also have a longer time frame in which for the stock's price to recover. and you'll get it much closer to your cost basis, and then you can start selling calls against it immediately. If this happens on any of the stocks that we trade live in my group, then we'll take that as it comes. This is always a possibility though, and you have to be prepared for it. That's a couple of options for you. And next we'll talk about selling a covered call. All right, now selling a covered call specifically refers to selling a call that is backed up by the actual stock in your account. Okay, selling a call that does not have shares backing it up is called a naked call. And selling one of those is a theoretical unlimited loss position. Okay, never, ever, ever, unless you're a pro, sell a naked call. Okay, never sell a naked call. All right, and if you're to the point where you can sell naked calls, then I doubt that you would be listening to this video. Okay, just don't do it. But we can sell covered calls all we want, and they're fantastic. So let's see here. Selling the call. This is essentially the same thing as before. But quite frankly, we don't really get a lot of these choices a lot. When I'm selling calls, so I'm going to kind of skip through this. You can stop and you can read this if you'd like. But the thing is, when we sell calls, and puts for that matter, what we do is we try to get a 1% return on what we're doing. That 1% return is kind of like the gold standard for me. So when we're selling calls, I want to try to find that. So if it's a $30 stock, I'm going to look for $30 worth of premium to sell that call, more or less. And that's how I can average out around 30% per year. And you'd think, well, if you're selling 1% per week, isn't that 52%? Well, not exactly, because you never have your whole account to the market, and I'll show you that in a minute. Kind of how I think people should space it out. You never have your whole account in the market. And there's always weeks where you're not taking in premium on something because maybe the stock price has fallen too far below your cost basis, and you're not comfortable enough to sell a call below the cost basis. Then you're not going to collect premium that week. Or if you have to roll a put, you're not going to collect premium on it that week. So that's why it tends to average more towards like 30%. But really, 30% is fantastic anyway. So, why complain about it? So, as far as what if the stock tanks, so you're going to want to sell your calls at purchase price or one strike above in order to lower your cost. If there's no premium there, generally for anybody here on YouTube, I'm going to recommend just waiting. Now, the thing is, for my clients and when we do this live, if it's too low and we need to sell stuff under cost basis, I do it all the time, but I've also been doing this for years. So I do it all the time, and if there's an issue, then I'll roll it, because I want to make sure that I don't get assigned beneath cost basis. I'll roll if I have to. I've rolled a month out before, even longer, actually. I think probably the record's about 6 weeks. It was on SoFi. I was rolling for 6 weeks, and just to keep from being assigned beneath cost basis. And eventually, as long as you're long-term bullish on the stock and it comes back up, then you're fine. Okay. Option 2 is to average down with more shares, and that's really only, A, if you're long-term bullish, and B, you wanted more shares, but you haven't entered them yet. And that's why if I want, say, 200 shares of a stock, I'm only going to enter 100 shares at first with one put, and then what I'll do for the next cycle is I'll essentially sell a strangle on the stock. So I'll sell both a covered call and I'll sell a covered put to try to enter that second half of the position. So that no matter what happens, I'm keeping the premium from one side of that, and I'm getting what I want. You know what I mean? So that's an option as far as averaging down. I would not recommend averaging down if it takes you out of allocation, though. All right. So you're going to determine what you'd like to do with the stock, how to sell a call. So, now there are some stocks that you actually have a lot of choices here. I look for the 1%, but if you just want, 0.5%, well, you can sell it way out of the money and you just want to keep that stock because you think that stock's going to run. And keep in mind, if you get assigned, you get the capital appreciation. So sometimes I'll sell a little bit further out of the money so that if it does happen to hit it, I'll take much more capital appreciation in. Because on a 100 lot, each dollar is worth $100. So it's, sometimes it can really be worth it. All right, now which stocks do I choose? First off, stocks with strong fundamentals. And this is something that we teach in our beginners courses, and we go through fundamentals classes every Wednesday night. You need a stock with strong fundamentals, and I'll go through a little bit of that in just a moment. You want to make sure the stock, of course, has weekly options with some volume. Yes, you can technically run a wheel with monthly options, but I don't like it. You don't have enough flexibility, so I make sure that they're all weekly choices. And you want some volume on them. If there's no volume, you're normally not going to get the mid. You're going to have to sell a little bit under the mid price, which you really don't want to have to do. So you want to make sure there's some volume in the stock. Make sure the sector is bullish for the foreseeable future. Okay, so if we're pushing into a rising rate environment, then perhaps small cap growth tech stocks are not where you want to be. I prefer stocks with dividends because that will add to the annualized rate at the end of the year, and it will just help boost up that rate a little bit. And besides that, stocks with dividends tend to be a little bit more desirable. A little bit. And you want to prefer enough volatility you can make at least 1% per week, and that's that average number right there. So the stock, a good example of this, people are always like, oh, well, how about AT&T? They have a great dividend, and they have weekly options. Well, not exactly. They don't have enough volatility for the options to be worth 1% per week. So that's an example that does not have enough. Okay, we'll do kind of a brief overview here of the kind of fundamentals that I'm looking for wheels. Now, if you want to get really into depth on this, this isn't the video for it. There's a lot of resources out there, and of course I teach all my clients this stuff. I have hours upon hours upon hours of video on this stuff. So essentially what you're doing, kind of a brief overview, make sure revenue is increasing year after year. You want a nice 45-degree curve upwards on the revenue. If it just kind of sits flat, bounces up and down, that sort of thing, there are better choices out there, okay? Generally, you want to be increasing year after year on the revenue. Now, make sure it isn't overvalued relative to its estimated earnings, right? So you can use PE here. My preferred method of measuring valuations is going to be enterprise value divided into revenue, but PE, I put that on here just because more people have access to that, and it's going to be a little bit easier to find. Make sure they aren't racking up debt with nothing to show for it, and I go through how to find that out in a lot of my classes, how to find out exactly what they're doing with their debt, and the various reasons companies take debt. Not all debt's bad, not at all. Many companies use debt to expand, and it makes them a better company for it. And there are some companies that just rely on it, like REITs, for example. But there are a lot of other companies that don't make any money, and they just rack up debt to pay their bills, burning billions every quarter. And that is not a company that I want in my wheel. You want to make sure they can pay all of their short-term liabilities. So a good way to do that is to look at a current ratio. It's all assets divided into liabilities. If it's better than 1.0, then in general they're going to be able to pay up their liabilities. That's a really quick and dirty way of doing it. There's other ways to do it that are better, but it's a quick and dirty way. You want to make sure they aren't diluting their share float, and that is just selling more shares and offerings month after month. That's going to, over time, decrease the valuation of the stock. And lastly, you want to make sure the dividend increases or at least stays flat and they can pay it. You want to make sure that dividend, best case scenario, what you want to see is kind of like a stair-step pattern going up year over year of them increasing the dividend every quarter. And you have to make sure they can pay it. So you want that payout ratio for the dividend to be 60% or less, somewhere around there. So revenue, You want to see, hopefully this year, them making more revenue than ever before, climbing over the past several years, and is expected to continue to climb for the next several years. So you need to look at estimates for that. Valuations, I'd say enterprise value to revenue is my preferred metric for valuation. Price to earnings, the PE, it's too easily manipulated because earnings is the bottom line on an income statement, whereas revenue is the top line. It's much harder to fudge. It's not that you can't fudge it, it's just that it's harder. And there's the calculation for enterprise value. It's market capitalization plus total outstanding debt minus cash on hand. It's the theoretical value that another company would have to pay to completely buy this one. All right, and let's talk about allocations. So I'm going to suggest, and this especially for a newcomer, you're going to want to choose a small group, 7 to 10 stocks. You will add into the position slowly to begin with. So, for example, if you want to get 200 shares or something, it's like what I was talking earlier, you sell one put, and then you wait and you sell strangles against that stock to get your second position. All right. You're going to add up to 70% of your budgeted account allocation over 7 weeks. That's what I recommend as the maximum speed. Okay? Maximum speed, 10% per week. And I say that because the markets have this really funny habit of going up really high and then pulling back real far and then going up really high. You guys know what I'm talking about. And if you average in more like that, you're more likely to get better entries. And with the wheel, entry is everything. Entry is everything with the wheel. If you enter into a stock and it's at all-time highs and it has a big pullback, you may not get your money back for years. That's why when I'm doing this with all my clients, we do this every Friday. We manage our wheel positions. I pull up the charts. I do deep technical analysis on every stock in this big income list that I have, and we make sure that our entries are right. The entry is so important, okay? Now ensure you sell positions before adding more to maintain that 70%. All right, don't really go over it. And here's why. The remaining 30% is used as a slush fund to enter a position on a deep and sudden, unexpected pullback, or to save underwater stocks by averaging down. You need that money. It's there if there's a stock you really want, like I was just saying, but it's at all-time highs. You're already allocated to 70%, but this one has a big pullback on something that isn't a fundamental game changer to the company. Well, okay, let's use some of that cash to get into that position because we know it's going to be a good position. And then the second thing here, if you do have an underwater stock and you want to average down, this is a little bit more of an advanced move, and you want to average down on it, there is that option as well. At the end of the month, I simply transfer out any cash in excess of your budgeted maximum account size. There's a couple of different ways to take your income, but that's one of them. Okay, so here's just a little chart. This is what I mean by adding slowly, okay? Very slowly, 10% per week. All right, that's going to be pretty much the end of the presentation. Thank you for listening. I appreciate it. Hopefully it was a helpful overview of the wheel. It's a very deep and complex strategy once you really get into it. There's a lot of nuance in various places, and you have to learn both fundamental and technical analysis in order to properly choose and then enter your positions. So it's not something that I can really properly explain in about 10 minutes, but that was a nice overview, hopefully. If you wanted to get in contact with us, website's tradersultimateedge.com. You can find us on there. You can find all the contact links on there, or you can just email me, Anthony at tradersultimateedge.com. Thank you. Have a great day.